This is terrifying. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, the unthinkable is starting to happen and why it will devastate the U.S. economy. Let's over to Bloomberg, where we picked today's story up with a headline: U.S. producer prices approach deflation with a 0.1% annual rise. Now, why is deflation so terrifying? Well, when you hear from central bankers, they'll tell you we can handle inflation. Doesn't matter how high it gets, even though it does, we can bring it down. We have the tools and the policies to bring it under control down to a sustainable level. But there's one thing that outright terrifies policymakers, and that's deflation, and I'll show you why. Normalizing global supply chains, stabilizing commodity prices, and a broader shift in consumer demand towards services and away from goods have generally helped alleviate inflationary pressures at the producer level. So here we can see the month-over-month numbers of the producer price index, 0.1%. Same with the core, which excludes food and energy. And you see the year-over-year rate of change in the producer price index coming down to a scant 0.1%, with the core falling behind. It's still slowing at 2.4%. So now the issue is we're seeing at the producer level price growth really slow down. Now, does that eventually translate into consumer prices? Well, it sure does. But let's take a look here at what's causing the producer price index to go down so fast and perhaps even go negative in the months to come. It all comes back to the energy sector. Here we have crude oil prices. That's the West Texas Intermediate in red, shown on a year-over-year rate of change against the producer price index. Final demand, which is important, and you can kind of note that it just appears that final demand for the PPI is just a smoothed out version of the energy sector, and to some degree it is. So as we can see where energy prices are going, well, it tells us that indeed, because these are different sides of the graph, that we have further to go on the producer price index, as we'll make the case here in a little bit. Now, when we take a look at gasoline prices, still now this in red, swapping out the WTI, you can see again the strong relationship energy has with producer prices, suggesting that, as we know, the CPI will indeed follow energy prices lower. Now, the risk here we have is the Fed is still hiking, or at least threatening to hike at the end of the month. And of course, what we know is they need to see this magic 2% number that they're looking for. The problem is, by the time they actually see it, due to the lags in the data, well, we're going to be plunging likely into deflation, and that's a huge problem. Prices of goods, meanwhile, were little change that's flowed through to consumers in the form of lower prices, something known as deflation. Goods costs fell 4.4% from a year ago, the biggest decline in more than 3 years. Food prices even dropped for the third straight month. And when you strip out volatile food and energy, the core PPI barely rose from May and was slowed to 2.4% from a year ago, the smallest since January of 2021. And these figures come just a day after the separate data showed consumer prices rose in June, as we covered, at the slowest pace since 2021. And so the question we're going to ask here, of course, we know the Fed again has continued to talk up the July rate hikes, and yet the question now that the markets and everyone's starting to ask is, are you actually going to hike after that? Well, let's take a look at the relationship between the consumer price index and final demand of the PPI. And here we can see in this chart where the producer prices go in final demand. Well, consumer prices tend to follow with a lag, so we can expect now in the months to come that it's likely that we could see the consumer price index, the year-over-year rate of change, coming all the way down here if you look at where the producer price index is headed. And that would suggest not only are we going to get to the Fed's target, we're going to go beyond that and below that, and then the risk of deflation will they start to take hold. And this is a big problem. If you talk about what is devastating for the U.S. economy, is the fact that if from producer's standpoint, what happens during inflation? Well, their cost of rent goes up, utilities goes up, the cost of manufacture goes up, the wages go up, everything goes up, and that tends to remain rather sticky. So what do producers need to see is a continued increase in inflation so they can get their margin back, because the first thing they do is squeeze their own below margin, and that becomes the problem. Now, when they start to see deflation, it means they're selling goods at a lower price than they were a year before, and that bodes poorly from a profit standpoint, poorly from a stock trading standpoint if you're looking to see your stock go up. And so ultimately, it leaves producers with only one avenue out to get their margins back up. Now, the cost of processed goods for intermediate demand, which reflect prices earlier in the production pipeline, slumped a whopping 9.4% from June of 2022, the sharpest drop since the global financial crisis in 2009. Excluding food and energy, these costs fell as well. And here you can see intermediate and final demand being in blue. Intermediate for processed goods is down here at a minus 9.26%. You got to go back, and that tells us that the PPI is coming down even further here. And of course, that means the CPI is coming down. And now you have a problem, because the question then becomes, what do producers tend to do as they face deflation if they need to get their profit margins back up at a time when demand is slowing? Well, if you said cut employees, you got it right. Now, we don't have a ton of data because the producer price index final demand data only goes back to about 2011 here on the Fred database. But what we can look back here at 2015 to 2016, we saw deflation in producer prices, and now we're overlaying the 4-week moving average of initial claims, and we can see that initial claims remained rather flat, whereas in an expansion, you tend to see them head lower. This case, they went flat, and now look what we're seeing now. You see, look at the timing of producer prices started to disinflate, and then whoops, they actually are almost on the edge of deflation. And look at this 4-week moving average of initial claims starting to tick higher here. But that's not the whole story, because now we look at this U.S. jobless claims dip to 237,000 as labor markets stay resilient. Now, when we look at this, some of you are saying, well, wait a minute, if this is true, we should see these numbers go up. Well, hold on, we've got the rest of the story coming here, because that's the seasonally adjusted number. But one thing that shouldn't be dipping right now is your trading account. If you signed up for CTA-Timer Pro, we're still looking at the QQQs here. We'll give you an update on soybeans and some of our other calls in future shows, but it would told you to buy back here. Now remember, everyone was super bearish. The machine positioning, which this report looks at and mimics and then runs a historical overlay, was at max short position down here, telling you that if any sort of movement up in the machine positioning, you should take position and buy. Then they pulled back here. People said, nah, this is going to go down. And the machines, yes, guess what? They started buying out of this dip too. Again, if you would have followed the report, taken positions here or here, you'd be up. This is still rallying. And what we can note on the report, here we go back to January 9th. We were almost at max short positions the day before. It bought up, and that was a signal to start buying. Here you can see on March 15th, there was a pullback in the report prior to this, and then it was buying back in, telling you, yes, add back into your positions or start taking positions. And then we noted on July 11th, there was a pullback in the machine positioning here a little bit. And many of you asked the question, what happens? How do you interpret that? Well, it means you can either take some profits, or as we like to suggest, just raise your stop loss level up. Look, this report's only $30 a month, and twice a week we put out a watch list saying these are the ones you should be watching to look for major reversals. All you got to do is sign up. 30-day money back guarantee. Now, as we look at continuing claims, which include those who have received benefits for longer than a week, that's up a little bit to 1.73 million. And we've talked about on prior shows that the continuing claims were dipping down a little bit and putting downward pressure on the initial claims. So it's not a terrible surprise to see initial claims pull back a little bit, particularly as we know that employers are still optimistic about the rest of the summer here, still needing labor. You still see that in the survey data. Hey, they still need people to work, but I think that story changes as we get closer to the end of the summer. The 4-week moving average of initial claims, which I've been saying when it sustainably breaks 250, watch out, the thing's going to get some legs, which smooths out, is now down to 246,750. Of course, they note in the Bloomberg article around mid-July during the annual auto retooling period, volatility can be expected, which may cause choppier weekly claims data. So we'll be mindful of that going forward. But here's the shocker. Here's, again, something that looks terrifying terrifying in the data on an unadjusted basis. So take out that seasonal adjustment thing, throw it out the window. Claims rose to 258,614 in the week ending July 8th, with New York, Ohio, Pennsylvania contributing most to the increase, and we saw New Jersey, Connecticut, and Michigan with the biggest decline. So if you're in New York, Ohio, and Pennsylvania, are you seeing something there? Share with us in the comments what's going on. Is there some big layoffs that are starting to happen? Are you seeing a big slowdown that could filter out to the rest of the economy? We want to know, because we talk about, again, this deflation story, and the Fed has no answer to the problem, because once you start getting deflation baked in, next thing you know, employers start to cut. And here we can see on this chart of the 4-week moving average of initial claims with a baseline at 250. And we've seen in the past, when you start to get at a certain point off of a low, now typically it's around 350 it breaks out. I didn't draw the line, but typically you see initial claims at 350, but we never usually get to these super low numbers. We have to go back to the 70s, and back then when you started breaking 250,000, next thing you know, the wheels on the economic bus just started to fly off. And so again, it all comes back to the fact, as people hit the unemployment line, they spend less, they have less discretionary spending, and it starts to flow through the economy. It doesn't mean a large number of people have to hit the unemployment line. It just means enough people have to hit it and not be able to find a job fast enough before their debts catch up with them. And here we can see other signs of the economy slowing down. That this one, again, no central banker can stop. And we see this from the IEA, the oil micro report from July, just released today. Look at this from the notes in the report. Benchmark crude oil prices traded in a narrow range in June as persistent economic woes overshadowed deepening supply cuts from some OPEC plus countries. Amid an overall slackening in oil demand growth, China's widely anticipated reopening has so far failed to extend beyond travel and services, with its economic recovery losing steam after the bounce earlier this year. So here is the oil report from the IEA saying, hey, look, this isn't just a story of deflation. This is a story of slowing global economic demand that we're seeing flow into the producer price index, which is leading to potential deflation, which will lead to falling consumer prices and eventually an increase in people losing their jobs. And that takes us down the path to how this is devastating for the U.S. economy, because it tells us we're headed right to a recession. But world oil demand is still coming under pressure, as I noted, from challenging economic environment, not least because of the dramatic tightening of monetary policy in many advanced and developing countries over the past 12 months. So the IEA says, hey, look, this is a story of central bankers, when we already know this is a story of slowing global demand. The fact is here, it doesn't matter that the OPEC plus countries need to cut production, because the more they cut, the more demand tends to slow down. In this case, it's just one thing chasing the other. It's not a sign of pulling oil prices up, because if we drive oil prices higher now, at a point when still many people around the world, and here in America, people are struggling with inflation, driving oil prices up and gas prices up is only going to lead to, you got it, less consumption. And more evidence of less consumption comes right back to our friends over in China, as a drop in exports signal deepening slowdown in global trade. Trade has been slowing for months, as we've been noting on the show, but the pullback has further to run, economists say, as central banks keep up their campaigns to beat back inflation and the U.S. and Europe slide toward a recession, because nobody wants to consume anything much anymore. But Chinese exports fell at their steepest annual pace in June since the early days of the pandemic in February 2020. Now you go back to those early days in February 2020, and then you slide a little further back to 2019, and you remember what we're talking about then? A slowing global economy heading into a recession. We're seeing those signs here once again. And China isn't the only Asian export powerhouse reporting sinking overseas sales. Exports from Taiwan fell a whopping 23% in June over last year, while Vietnamese exports were down 11%. Exports from South Korea, big electronics exporter, were down 6%, which is staggering when you put that all together. For Beijing, the steepening downturn in global trade intensifies the growth challenge facing the world's second largest economy. A consumer-led recovery is failing as households contend with a weak labor market and a drawn-out downturn in China's real estate market, scotching hopes for a vigorous rebound from almost 3 years of strict COVID-19 controls, which we've been saying has nothing to do internally with China's economy, because China's economy is a function of the rest of the world. When you're the world's biggest exporter, what happens outside of your country, of course, if you're feeling prosperous as a worker in China because you're seeing new orders and demand coming in and you're seeing trade happening, well, what are you going to do? Probably go out and buy some property, go out and spend some money. But if you're seeing the opposite of it, what aren't you going to do? Spend. And China's exports to the U.S. fell a whopping 24% in June compared with this time last year. And there's your sign of demand coming out of the U.S. going into the toilet. Shipments to the European Union sank 13%, and sales to the Association of Southeast Asian Nations, a group of 10 countries, fell 17%. U.S. imports of goods were 5.5% lower in the first 5 months of the year than the same period a year earlier. Goods imports fell 2.7% in May compared with April after recording a brief rebound. And what does that mean for the labor market, my friends? Well, if you're not bringing goods into the country, you don't need people, because you're not seeing new order demand. You're working through your backlogs. You don't need people to move products through the country. And lo and behold, look at this chart here, where we've got the 4-week moving average initial claims in blue against imports of goods and services to the U.S. shown on a year-over-year rate of change. And if you say they kind of look like a mirror each other, well, you've got it. As trade comes down, you need fewer workers. We can see that over and over and over again here, suggesting that what we're facing is indeed going to be devastating for the U.S. economy, not just us too, but the rest of the world, because this isn't supposed to happen. The central bankers were supposed to bring inflation down to a nominal level, but what's going to happen is they're obviously going to overshoot it, cause massive deflation, lead to major unemployment and a global recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.